The New World Order is being rewritten, and equity investors need a new playbook. For almost 3 decades, investing felt simple. Globalization expanded, inflation stayed low, interest rates kept falling. America dominated economically and technologically. Investors were rewarded for buying growth, staying passive, and buying every dip. But that world is changing. A new global order is emerging. Slower globalization, rising geopolitical tensions, strategic nationalism, artificial intelligence disruption, energy insecurity, and structurally higher inflation. The rules that worked between 2010 and 2021 may not work the same way over the next decade, and yet many investors are still positioned as if the old world never ended. The market is not collapsing, but leadership is changing. Capital is rotating differently. The world is increasingly dividing into economic blocs: the United States and its allies, China and its influence network, resource-rich emerging economies, and strategic neutral nations like India and the UAE. Supply chains are no longer optimized only for cost. They are now optimized for resilience, security, and strategic control. This means more domestic manufacturing, more defense spending, more semiconductor investment, more energy independence, and more infrastructure rebuilding. The winners of the next decade may not be companies selling the cheapest products. The winners may be the companies controlling infrastructure, energy, technology, data, and supply chains. And then there is AI. Most investors still see artificial intelligence as just another technology trend, but AI is becoming something much bigger, a productivity layer for the global economy, like electricity or the internet. Entire industries may become dramatically more efficient over the next decade, but the biggest winners may not be flashy apps. They may be the companies powering the AI ecosystem itself. Semiconductor firms, data centers, cloud infrastructure providers, cybersecurity businesses, industrial automation companies. Because every AI model requires chips, electricity, cooling systems, and digital infrastructure. The next investment boom may be built on picks and shovels, not hype, and then comes energy. For years, energy companies were ignored because the world believed fossil fuels would disappear quickly. Reality turned out to be far more complicated. The energy transition itself requires enormous amounts of copper, uranium, natural gas, and grid infrastructure. The future may not belong only to old energy or new energy. It may belong to whoever controls reliable energy supply. At the same time, higher interest rates are changing market behavior completely. Cheap money once rewarded speculation, leverage, and unprofitable growth. Now capital has a cost again, which means investors may increasingly favor companies with strong cash flow, pricing power, low debt, and strategic importance. This is why market leadership is becoming narrower and more selective. The next decade may reward adaptability more than blind optimism. Investors may need to think differently, own dominant market leaders, but also diversify into real assets. Pay attention to energy, infrastructure, industrial metals, utilities, defense, and logistics. Stay flexible, hold cash tactically when needed. Rotate sectors when conditions change, and avoid emotional investing during periods of extreme euphoria. Because wealth is rarely built by reacting to headlines. It is built by identifying structural trends early and staying invested long enough for them to compound. Every market era creates a new set of winners, The post-2008 world rewarded globalization, passive investing, and cheap capital. The next decade may reward strategic allocation, infrastructure, energy security, and AI-enabled productivity. The world is changing in real time, and investors who adapt early may not only protect wealth, they may compound it far faster than the broader market.